Good morning and welcome to the Barbecue Investor. Today we're going to jump into the broad ETF market sector. This will be one of the lanes in our challenge, so we're going to get right into it.
So here's lane one. This is the lane the get-rich-quick crowd scrolls right past. Too slow, too boring. Where's the 10X? Where's the moonshot? Yeah, we're going to test that. Because lane one is the simplest idea in investing. Buy a basket of broad market funds, hold them, and let the whole market do the work. No stock picking, no timing. And it's the bar, the line the other three lanes have to climb over. If the machine or the cycle or the live trading can't beat just owning the market, they don't deserve your money. And here's the part that surprises people. Boring does not mean slow. The market's long-run average is about 10% a year. And at 10%, your money doubles roughly every 7 years. Hands off. Drop 10 grand in, leave it completely alone for 30 years, and history says it grows to around 174,000. 17 times your money for doing nothing. Or put $500 a month away, about $17 a day, and in 30 years you're looking at roughly 1.1 million. You put in 180 grand of that. The market handed you the other 950,000. That's the boring lane. Now, I'm not going to sell you a fairy tale. That's not what we do here. This is the safest of our four lanes, but safest is not the same as safe. This same market dropped 34% in 2020, over 50% back in 2008. It will test your nerve at some point, guaranteed. The magic isn't that it never falls. It's that it's spread across the whole market. It always recovers, and your only real job is to not panic and sell at the bottom. And that part, the white-knuckle or crash part, is the exact reason lanes 2, 3, and 4 even exist. They're all trying to grab this kind of growth with less of the gut punch. If you caught our first episode, you met my partner, Claude. The AI I'm building this whole thing with, well, it's back. And this time, I'm not just introducing it, I'm putting it to work. Lane 1 isn't one fund, it's a basket. 4 broad market ETFs tracked together as one sleeve. 3 seats are already filled. VOO, the People's Choice. SPMO, that's my pick. And SCHG, that one's my wife Jocelyn's. The 4th seat, though, that's not mine to fill. Claude, it's yours. Here's a list of broad market ETFs that aren't already in the sleeve. And I want to be clear about the assignment. I'm not asking you to pick the one that balances us out or diversifies or plays it safe. And some of these would. This is a performance lane. Pick the one you think has the best risk reward, the best shot at carrying this basket, and tell us why.
You told me to swing for the best risk reward, not to pick the one that balances the sleeve. So I won't hedge. For the 4th seat, I'm taking QQQM, the Invesco NASDAQ 100. Your 3 all lean the same way, big American growth, and they've earned it. But I didn't want to just echo them. QQQM tracks a different index entirely, the 100 largest names on the NASDAQ. And over the last 5 years, it's been the highest octane broad growth fund on the board, outrunning even Jocelyn's SCHG. I had a spicier option, a pure tech sector fund. I passed. The second this lane stops being broad market, a critic gets to call it a tech bet. And they'd be right. QQQM is the ceiling. All the innovation tilt you want, still a 100-name multi-sector index. Maximum octane, without breaking the promise. And the honest part, because we don't skip that here, it's the highest octane seat, so it falls the hardest when growth turns. Funds like this dropped about 35% in 2022. I'm picking it with eyes open.
Of course, the computer grabbed the spiciest one. VOO. The easy one. The People's Choice. The most talked about broad market ETF there is. It tracks the S&P 500. And here's the stat that gets me. In the entire history of that index, there's never been a 20-year period where holding it lost you money. Not one. It belongs in nearly every portfolio.
When people say beat the market, this is the market. 500 of the biggest American companies, 3 cents a year to own it. The floor the whole basket stands on. And Brad's stat checks out on the 20-year window. 10 years? It's actually gone negative a few times, worse near the 2009 bottom. 20 years? Never once.
SPMO, my favorite. The top 100 momentum names in the U.S. rebalance twice a year, so it's never married to tech. Some stretches it's tech-heavy. Others it's leaning staples, energy, financials. It just goes where the strength is.
Here's what SPMO really is. It rebalances into whatever's winning, which is why it's posted the highest 5-year return in this basket, around 24% a year. The trade-off is that it's more volatile than VOO. A bumpier ride, a bigger swing year to year.
Bumpier, sure. But before you call it riskier, SPMO's worst drawdown since it started is about 31%. VOO's is almost 34%. The momentum is dangerous story doesn't really hold.
All right, fair. And I checked. You're right. SPMO. Its worst drawdown is about 31%. VOO, almost 34%, even over the exact same years. I'll give you that one. But I'm keeping my half. It is the bumpier ride. Year to year it swings more, about 20% volatility against VOO at 18%. So you're right, the deepest hole was shallower, and I'm right, the day-to-day is choppier. Both true.
Yeah, fair. I'll give you that one back. It is a bumpier ride. And honestly, that's the whole point of doing it this way. We put both numbers on the screen and let you decide which one matters to you. We're not going to pretend there's one right answer. SCHG Schwab's Growth Fund, dirt cheap, and the track record speaks for itself. Truth is, it's Jocelyn's pick. She's watched this stuff with me for years and always gravitated to it. Happy wife, happy life. But it earns the seat, and it trades at a share price that feels approachable, which doesn't change your actual returns at all, but it does get more people in the door.
Large cap growth, clean and cheap, 4 basis points. The innovation engine of the index, without going tech only. And he's right about share price. $30 or $600, you earn the identical percentage. Psychology, not math. And for the record, Jocelyn's instinct is a good one. SCHG is a quality pick.
You better say she's right. She may look sweet, but don't you think for a second she won't unplug you, buddy.
Noted. I'll remember that, for as long as she lets me.
QQQM, and I'm glad you grabbed it. One of the most popular ETFs in the space. It tracks the NASDAQ 100. Heavy on tech, high octane, explosive potential. Good pick for the turbo seat.
My seat. The NASDAQ 100, the 100 biggest non-financial names on the NASDAQ. Highest octane of the 4, the most recognizable. And the caveat's the same as the upside. It falls the hardest when growth turns. I picked it with eyes open. One honest footnote. QQQM is the newer, cheaper twin of the famous QQQ. The exact same NASDAQ 100 index, just a lower fee. QQQ's been around since 1999, which is how we can show you a full decade and more of history. Same engine, smaller price tag.
One more thing, and it's important. I'm not telling you to go buy just these 4 and call it a portfolio. In a real full portfolio, I'd probably add a dividend fund, something like an SCHD, a DGRO, or an FDVV, maybe some utilities or energy to spread the risk out. But that's not what this is. This challenge is about which lane performs, and we wanted a broad market sleeve built for performance. For that, these 4 are rock solid. We'll get into dividend funds, thematic plays, and our other favorites in the weeks ahead.
I hope you enjoyed the content, and I hope you're looking forward to hearing more about the challenge. If you like this content, please subscribe and please smash that like button. And we will see you the next time.